Hi, today I'll be talking about the impact of interest rate changes that affect the valuability of a bank. And this will be the four table of content that I'll be going through for today. So firstly, how does interest rate changes affect banks' viability? And what is interest rate? In general, right, interest rate may be the sum that a borrower must pay a lender, usually in percentage form, and the interest rate is actually charged to the loan amount. So example, today I borrow 100K and my interest is 2%, which is extra $200 that I have to repay on top of the 100K that I borrowed. Interest rate may also mean the sum accumulated in an investment over a period of time. How does interest rate affect bank? So when interest rate rises, right, banks' profitability will rise as well. So net interest margin. The net interest margin actually makes up a sizable amount of bank revenue. The difference between is that bank is earning interest on loans and the interest paid on deposits. The different interest rate may get wider as they climb, which might boost profitability. Secondly, investment income. The return on banks' investment portfolio, especially those including fixed income securities, can be positively impacted by a higher interest rate. Higher interest rate can help with economic growth as well. So firstly, attract savings. So people may earn more on their interest on their savings account, may want to earn more on interest on their savings account and other fixed income investment where interest rates are higher, which might encourage people to save more on their savings account. This may result in more money being available for bank loan. Secondly, inflation control. In order to combat inflation, central banks frequently raises their interest rate. Higher interest rate can help to reduce inflationary pressure by raising the cost of borrowing, which promotes macroeconomic stability. Thirdly, strengthening of currency. A stronger currency can result from high interest rate drawing in foreign capital. Positive effects of inflation and imports may result from this. Higher yields return. The higher the interest rate, right, increases the return on banks' investment. The price of existing bonds may decrease in a scenario where interest rate rises. So on the other hand, newly issued bonds actually have higher interest rate, giving bank the chance to put money into assets with higher enticing yields. So this is the illustration that about what I have just mentioned. So high interest rate lowers inflation and calm on overheated economy. This is because companies are likely to halt or scale back growth project as a result of high interest rate, which may make borrowing costs more prohibitive for business plans. Higher deposit rates make savings more attractive, and people may think about investing in securities and companies or industry that will actually profit them from the rising interest rate. So what happens when interest rates fall? Low interest rate generally promotes inflation and economic growth. This is a result of the lower cost of borrowing for companies. Businesses will actually start growth initiatives like company acquisition, expansions, and product developments if borrowing costs are actually lower. Lower deposit rates make savings less attractive. Instead, people are more inclined to use their extra money to buy investments product in order to maximize their returns. And I'll be talking about how banks' operational model may accentuate or mitigate the impact of banks. So firstly, assets diversification. Bank can actually reduce the impact of rising interest rate by diversifying their revenue streams. Bank with a heavy reliance on lending can diversify into sectors such as wealth management or investment banking. This can help bank in reducing their dependency on lending while lessening the impact of rising interest rate on loan demand. It is crucial to have a well-diversified asset portfolio that consists of both short and long-term investments, which the bank should invest in. So firstly, risk mitigation. Spreading the risk over several asset classes and maturity is better, while long-term assets may actually offer higher returns but more price volatility. Short-term assets might be less vulnerable to changes in interest rate, offering stability, and both of these together, right, actually can reduce the portfolio risk overall. Secondly, revenue generation. Higher yields are frequently found in long-term assets, such as bonds with longer maturity. This can help generate income when included in the portfolio. Though their yields are lower, short-term assets might actually offer more income stability. The combo aids in balancing the demands for income. Secondly, assets liability management known as ALM, in order to help bank manage the risk management related to the maturity and cash flow mismatch between assets and liability. ALM is actually an essential function, ensuring that banks' asset and liability are in line with the respect to maturity and interest rate sensitivity, sustaining a sound balance sheet, maximizing profitability, and reducing risk, particularly interest rate risk. Secondly, interest rate risk management. In order to offset the effect of rising interest rate, bank must also be able to successfully manage their risk. This includes managing bonds portfolio and having sufficient liquidity to deal with changes in deposit levels. So for banks to resist the effects of rising interest rate, effective risk management is actually important. And I'll be talking about DBS Bank as the case study. So in second quarter of 2023, right, one of the factors that has both positively and negatively impact on DBS Bank interest rate is on their net interest margin. So firstly, net interest income. Due to higher interest rates, commercial bank net interest income actually increased by 54% from a year before and by 6% from the previous quarter. This suggests that higher interest rate may actually greatly benefited DBS banks. This means there is actually a positive impact on DBS Bank, may have also been able to increase their yields on its commercial lending operations by taking advantage of the current favorable interest rate environment. Secondly, loan. A strategic choice to control risk and concentrate on more profitability lending opportunities may have led to the 10% drop in the trade loans, which was actually caused by a general slowdown in the markets and unappealing prices. However, non-trade corporate home and wealth management loans stability indicates this market reliance. Thirdly, deposits. The 3% decline in deposits, which was actually specifically linked to the decline in CASA deposits, which is current and savings account. So more people agree that CASA deposits are more reliable and affordable source of fundings for banks. The bank's ability to finance its operation with less expensive funds may be impacted by decline in CASA deposits, which could have actually effect on the net interest margin. Lastly, trade loan. The 10% decrease in trade loan is due to unappealing prices and also a general slowdown in the market. This implies that the viability of the trade loans may have been impacted by particular difficulties in the trade finance market or general economic conditions outside of the trade. So although the interest rate rise in net interest income from the commercial bank indicates that DBS Bank's interest rate viability, the bank will need to manage its interest rate risk by funding strategies in light of the decline in deposits, especially in the CASA category, and difficulties in the trade loan segments. So in conclusion, interest rate fluctuations may have complex effect on the bank's viability, impacting its profitability, funding expenses, and overall stability of the financial system. So it actually affects banks and financial institutions' earning expenses, and it plays actually important role to the banks and financial institutions. Interest rate affects the overall financial stability. So in order to actually successfully navigate the complexity of interest rate fluctuation and ensure long-term financial stability, right? Banks that actually prioritize their customers and implement strong risk management and diversification strategies are considered successful. So in a financial environment that is consistently shifting, strategic adoption is essential for both survival and also for success. Thank you.